talk about investing. For many financial education enthusiasts like yourself, people that are passionate about their financial future want to do better with their money. Investing is one topic they always want to learn about. So in this module, we are going to be learning so much about investing, the different types of investment that are out there, and how you can take advantage of it. First, I would like to categorize investment into 3 buckets or brackets for you, so you'll be able to understand it better. We are going to look at the bucket of low-risk investments, medium-risk investments, and high-risk investments. When dealing with investment, we cannot but talk about risk. So putting it in these categories would help you understand them better and how much risk you expose your finances to when you engage in any of these types of investments. So for the low-risk investment brackets, we have investment opportunities like fixed income savings, commercial papers, bonds, treasury bills, and mutual funds. Why are they called low risk? This is because somebody else bears the risk of this investment. What do I mean? When you invest in any of these type of assets, a company or the government bears the risk involved in utilizing that money to generate profits. And they make a promise to you as an investor that surely they will return your capital to you with the interest. With low-risk investments, the returns are not usually as high as other types of investments because, again, somebody is bearing the risk. And this is the point I would like to mention, a fundamental investment principle you must understand if you want to succeed on your investment journey. And that is, the higher the potential return, the higher the risk. If you see an investment that promises you a relatively higher return, with that principle, you should be able to tell that it also comes with higher risk. Risk and potential return, they go hand in hand. And I say potential return because your profit or your return or your interest is not actualized until you get your returns and your capital back. So what you get at the beginning of any investment is often a promise, a potential profit, a potential return. Now, in the brackets of low-risk investments, let's dive deeper. Commercial paper. When a company or the government offer commercial paper for investors like yourself to invest in, they are basically saying, give us your money, we'll run business with it, and give you back your capital with profit. This falls under what we call debt instrument, because your investment is sort of like a short-term loan you're giving the company or the government. Commercial papers can offer up to 23% to 30% per annum in returns. But most times, the minimum capital is in millions. So that's one of the cons of investing in commercial papers. Unlike other forms of investment where you can start with as low as 5,000 Naira. Next on our list, let's talk about treasury bills. For treasury bills and bonds, they operate on the same principle, which is, like commercial papers, you are giving your money to the government. You're investing in a debt instrument, basically saying, I'm investing in this bond for this particular time, known as your tenure, and you would get a fixed return on what you've invested. So for treasury bills, it tends to be longer. And for bonds, you can see bonds that are within a year, that you can liquidate it and get your capital back. While in some cases, it can take longer. It depends on the offer. Treasury bills and bonds, they are siblings. They operate on the same principle. Now, let's talk about mutual fund. Mutual fund is like a pool of funds. So investors like yourself put money together in a pool, the mutual fund. Now, there is an asset manager that manages this fund and invests it in different assets, usually low-risk assets like bonds, treasury bills, and a small percentage can go to equities like stocks. The good thing about mutual funds is you don't have to bother about managing the fund. There's an asset manager that does that. And it often comes within 18 to 20% in return, at least as at the time of recording this program. The very common form of mutual fund you see out there is what we call the money market fund. And a lot of conservative investors have found that to be their go-to when they are looking for an investment opportunity. For the low-risk investment bracket, we've touched on some of the major ones. But it won't be complete if I don't talk about the fixed income savings. Fixed income savings can also serve as a form of investment, especially in recent times where it pays close to what you would get from bonds and treasury bills and the likes. Fixed income savings is quite common with a lot of financial institutions and fintech platforms nowadays, where you can fix your money and get returns according to how long you fix your money for. If you are a conservative investor, exploring the low-risk investment bracket is the way to go because there is less risk and there is predictable return. If that is you, you can consider it. Now let's move further to the medium risk bracket. This is where we have assets like stocks and real estate. Although some people will argue that real estate now falls under high risk investment. But for the sake of this program, we'll still categorize it under medium risk. So how does the stock market work? When you buy a share of a company, you buy a piece of that company. As a shareholder, you become joint owner with many other investors like yourself. When you see a company on the stock market is worth, say, 1 million Naira, as an example, that means there are investors like yourself that own a piece of that company according to the number of shares that they own. I particularly like stocks because, like real estate, it's about ownership. So how do you benefit from the stocks that you've invested in? There are two ways. There's what we call capital gain and dividends. Let's talk about dividends first. So dividends is a portion of a company's profit that is paid to their shareholders as a form of reward. As I've explained earlier, when you invest into a stock of a company, you become joint owner of that company. And that is invariably you investing into a business. So a business that makes profits can decide to reward you as part owner of that company through dividends. Now, not all companies pay dividends on the stock market. There are some that pay dividends and there are some that don't. It's up to you as an investor. If dividends is an important thing to you, you can look out for them. Now, let's talk about the other way you can make money from your stock, and that is capital gain. Say you buy a share at 20 Naira today, and 6 months down the line, the share price is now around 30 Naira. If you sell at 30 Naira, you would have made a capital gain of 10 Naira on your investment. That is capital gain explained. So the profit you've made on what you bought and selling at a higher price is your capital gain. That is your profit. These are two fundamental ways stock investors make a lot of money from the stock market. The other type of investment that falls into the medium risk bracket is real estate. Some of us grew up seeing our parents benefit from rental income. And even till now, those properties are still producing rental income. Another way people benefit from investing into real estate is what we call land banking. So you buy a piece of land with the hope that it appreciates in value in the future. And you sell. So basically, you've put your money in there with the hope that it will grow in value over a period of time. This can be successful if you are strategic enough to pick a location that has so many prospects. Another strategy of real estate investment that people benefit from is what we call flipping, where you buy property and then you flip it for a higher price. So most times the strategy can be to either upgrade the property or wait for a period of time for it to appreciate. A lot of people make good money from land flipping. The very common one people can't stop talking about now is the Airbnb method, where you lease out a property and you put it on a short stay platform where guests can come in and stay in your property for a short period of time and pay you per night. It functions more like a semi-hotel, but it's not exactly a hotel. They call it home away from home. And in recent times, a lot of people have benefited greatly from this model. Although some people will now argue that this type of real estate investment is oversaturated. But there is always a competitive advantage one might still find to leverage on. You never know. Passive real estate investment also exists, where maybe you partner with a developer that uses your money to develop properties and just give you a steady return annually. That is usually based on you knowing or trusting the developer yourself or through personal network. The last bracket of the investment category we mentioned earlier is the high interest investment. And in this category, top of the list, we have cryptocurrency. This model will not be complete if we don't talk about cryptocurrency, because we can no longer ignore that cryptocurrency is here to stay. It has proven itself over and over again. But it is a very high-risk form of investment. People have made mistakes in the past, losing a lot of money to cryptocurrency because they don't understand the fundamental rule of investment. The higher the potential return, the higher the risk. So people rush to cryptocurrency because it can go from 1 to 100 in a matter of days. But they forget that it can also go from 100 to 0 in a matter of hours. That's the reality of cryptocurrency. But there are still opportunities there that a lot of people are benefiting from. It has been said and proven that investing in some of the stable coins that have a little more stability on the cryptocurrency market can be a smart strategy for investors that are looking to hold those kind of assets for the long term. And it can be truly rewarding. Another form of high-risk investment we have is Forex. When Forex entered the mainstream African or Nigerian market, it was a major thing. People rushed into it like cryptocurrency without enough knowledge, and a lot of money was lost. When most of these online financial gurus are preaching these high-risk investment strategies to you, they forget to mention that the fact that it can make you a lot of money in the short term, it can also lead to heavy loss of capital. Forex trading is about trading currency pairs, and it is a very complicated type of investment that requires extensive study. In my own opinion, I honestly don't consider it as an investment. For day traders, I consider it as more of a career because you have to be willing to dedicate a lot of time to trade Forex and to be successful at it. It has been said that over 90% of day traders always end up in loss. So be careful if Forex is something that has caught your attention in recent times. I want to talk to you about diversification. As an investor, you must understand the importance of diversification and the role it plays on your investment journey. Diversification is so important because it helps reduce the risk you expose yourself to per time. See it as, instead of putting all your eggs in one basket, you find like 5 different baskets and you distribute your eggs into them. So should anything happen to one basket, you still have 4 baskets that are doing well and strong. So let's talk about the different types of diversification you can do as an investor. First, you can diversify into different assets. Like we've talked about, we have the low-risk investment brackets, the medium risk, and the high risk. According to your risk appetite, time horizon, and your financial goals, you can distribute your financial resources across these different types of assets. Another type of diversification you can do is what we call sector or industry diversification. So say instead of investing in just one industry or one sector, so instead of just investing in one industry or one sector, you spread your investment across different sectors or industries. For example, let's say you spread your investments across the oil sector, manufacturing sector, health sector, and agriculture sector. Now, should anything happen to the oil sector, your other investments would most likely not be as heavily impacted as the investment in the oil sector would be. This way, you have reduced your risk massively. Another form of diversification is diversifying into different economies. For example, instead of investing all your money in Naira, you decide to have some investment in dollars, pounds, euros, or any other form of economy or currency that you value. This way, should anything happen to the Naira or the dollar, for example, you have your other investment thriving and doing well for you. Do you get the concept of diversification now and how it helps you to significantly reduce risk as an investor? It can also help you increase opportunity that you have by exposing you to other economies that can give you possibly more returns, or other assets that can give you possibly more returns than when you invest in just one type of assets or economy. Long-term investment strategies and short-term investment strategies are the two types of strategies that a lot of investors focus on. So let's talk about them. Long-term investment strategy is basically when you as an investor, you're investing for the long term. Say you're building a stock portfolio that would help you retire, say in the next 10-15 years. Or you are investing in real estate so that you can have something to fall back on in your retirement years, or something to finance your children's education at the time they are in higher institution. With the long-term investment strategy, it is fundamentally focused on the potential gain in the future and not so much in the now. For short-term investment strategy, investors that embrace this type of approach are more focused on their short-term gains. So you see them looking for investment opportunities that can give them immediate gains, say between 6 months to 2 years. There are pros and cons to both investment strategy. Fundamentally, it is said that long-term investment strategy can be more profitable because when a short-term investor is taking his or her profits to enjoy in the now, the long-term investor continues compounding with a heavy potential reward in the future. While for short-term investors, the pro is also that you get to enjoy your returns in the now. While the con is you might get lost in that rabbit race and you end up not building something substantial for the long term. So what do I think? I think both strategies can work for you effectively depending on the type of investor you are. And there is no rule that says you cannot combine both strategies. You can have some long-term investment in play for your financial future, while you have some short-term investment strategies in play for your now. Even for your short-term strategies, when the return comes, if you are disciplined enough, you can reinvest it to further grow your investment portfolio. You can make it work for you, so far you understand both strategies and the purpose they serve on your financial journey. So what are the things you must look out for before you make an investment decision? There are some personal questions you must answer for yourself before you choose the perfect investment opportunity for you. I know in the age of social media, there are lots of financial gurus advising you on different types of investment online. But it is important that you don't get lost in the herd and you find the strategy and the opportunity that serves you. The first thing you must be clear on is your financial goals. What is the goal you want this investment to serve? Do you want it to give you passive income for life? Or you're just looking for something that will give you predictable returns? What do you want to achieve? Be clear. Next, you must consider your time horizon. How long are you willing to stay invested for? If you are a short-term investor looking to just stay invested for 1 year, let that be in view when you choose an investment opportunity. If you don't mind staying invested for 5 years, 10 years, 20 years to come, that should also be in view. So it is important that you're clear about your time horizon. Another thing you must be clear on is your risk appetite. You must understand the amount of risk your finances can afford to bear. For example, a single mother of 2 catering to 2 boys alone cannot possibly bear the same risk as a tech bro that is single with no external financial responsibilities. So you must be clear on what your financial situation is and the amount of risk that you can endure in your finances in a way that doesn't destabilize your financial life. I believe with this model, you are no longer a novice when it comes to investments. You now understand the different categories of investment we have out there. You now understand the importance of risk and potential return. You know to only choose investment opportunities that serve you. You understand the importance of diversification. You've learned so much in this module, and it is important that you put them to work. Well done.